at the top of the hour, so good afternoon, everyone. My name is Liz Beneski, and I'm the Chief Executive of AmSham Abu Dhabi. It is my great pleasure to welcome you to the Corporate Tax Law of the U.A.E. and Regulations discussion today, part one of a two-part series being hosted by our AmSham Abu Dhabi Legal Affairs Committee and Banking and Finance Committee. These are the kind of great informational opportunities we provide to not only our members, but the general public. We hope you'll enjoy this. It is being recorded, so do be mindful. Keep yourself on mute, get questions going in the chat room, and we will have a fantastic engagement ahead of us. That's enough for me. Allow me to introduce Zahir Anis, who is going to be your MC for today. Zahir is the Vice Chair of the U.S. U.A.E. Public Affairs Committee and partnered Elliott Haddad Shahid Chartered Accountants. Zahir's been with AmSham for a mighty long time and has helped pull this panel together. Zahir, welcome and have a great event with us.
Thank you so much, Liz. Very happy to see such a good response. Welcome everyone to our webinar. We have all-star cast here to present this important subject, and I will get to the introductions. Corporate tax is the hot subject for everyone here in the UAE, but as most are learning, corporate tax isn't new to this region. Actually, there's our neighboring countries in the GCC had introduced taxation as late as the 1950s, and now it has come upon us here in the UAE. Obviously, we understand that the UAE, as it grows and it becomes a global player in the world economy, this is sort of with passage of time, this becomes a sort of requirement as part of being a global player. And but the good thing is that we are very confident with respect to this tax, and the tax revenues collected are going to go towards supporting the advancement of the UAE, the diversification of the economy, and increase best practices and transparency in our side of the GCC. So with that, I'm just going to pull up the bios here for our presenters. If you just give me a moment. Our first presenter I would like to introduce is Mr. Charles Laubach, board member at AmSham Abu Dhabi and member of the Legal Affairs Committee. Charles has lived in the UAE since 1986, both in Abu Dhabi and Dubai. Charles's law firm, Afridi and Angel, was a founding member of AmSham Abu Dhabi, which was formally recognized in 1990 and was formally recognized by Abu Dhabi government in 1996. Charles served as AmSham's first chairman and thereafter served on the board of directors for several years. Charles is one of only 5 recipients of the Ambassador's Award, which Ambassador David Litt awarded to Charles in 1996 in recognition of his leadership role in support of American business interests and in the formation of AmSham Abu Dhabi. In addition, Charles has been a member of the AmSham Dubai since establishment in 1986, and he has served on 2 occasions as the Vice President, Legal Affairs and Secretary. Charles is a partner at the law firm Afridi and Angel and is a corporate member, founding member, and he holds a JD and MA from University of Pennsylvania and an MA from University of London School of Oriental and African Studies and a BA from Dartmouth. Our second presenter is Thomas Vanhee. He's a partner at Orifer. Thomas's tax career spans more than a decade. He has worked at Tier 1 tax law firms in Brussels and Paris. Thomas moved to the Gulf in the beginning of 2017. He provides high-quality, innovative tax advice to clients, has been involved in several high-profile deals, and has worked for blue-chip and quoted companies and institutions in various sectors. In recent years, he was heavily involved in the European tax policy projects, as well as projects with several European governments, and in the Gulf region due to the pending introduction of VAT Thomas joined his former university, renowned Solvay Brussels School of Economics and Management, in teaching an introductory course on tax law, and also teaching at Sorbonne, Abu Dhabi. He publishes regularly and in international books and tax technical magazines, and is a regular speaker at international events. Thomas holds a law degree from Catholic University of Leuven and a tax master's degree from Solvay Business School, and has a hands-on, proactive approach and extensive technical skill set. And we have one more speaker here, Mr. Jishan. Jishan Mohammed is an accomplished CA, boasting a robust experience encompassing accounting, finance, management, tax, and compliance. He is currently serving as the regional head of finance and compliance at Global Advocacy and Legal Counsel, and plays integral roles as partner at ZBS Accounting, Bookkeeping, and Tax, and is the managing director of GIA. Jishan is a certified accountant holding a master's degree from MG University in India, and has successfully attained the ACCA qualification in accounting, alongside obtaining the ACAMS certification in anti-money laundering and compliance. Jishan has adeptly managed financial functions of diverse entities across various jurisdictions, and has the aptitude for financial analysis and reporting. Wow, so we have an all-star cast, as I mentioned, guys. So we have a wealth of experience here to help bring in some answers, as well as some knowledgeable points with respect to the corporate tax law. And hopefully by the end of this webinar, you'll come away with a better understanding of the law. We'll have some of your questions answered, and help you prepare in your various business environments for the law that has come into place. I'm just going to do a bit of housekeeping. We do have a Q&A opportunity here to the presenters. So I would request you to put your questions into the chat box, and we will take them up during our presentation. So with that said, let me begin with our first topic. And I will call upon Mr. Charles Laubach. Charles, could you give us an introduction onto this aspect of the corporate tax law, when it has come into effect, who is going to be covered, and what other rates are we going to be expecting?
Certainly. Thanks very much, Zahir, and thank you everyone for joining us today. I think this will be an interesting topic, but the number of people who've signed up, I think, makes it pretty clear that there's a lot of interest in this. Can you go to the next slide, please? Number 7. Here we are. Yeah, I'm going to talk about the big picture. The corporate tax law. It's a new statute here in the UAE, and we should all bear in mind the fact that it is now the law has been enacted. It took effect. It took effect on the 1st of June this year, 2023, and it will apply to taxpayers. I'll get to what a taxpayer is, who is covered by the statute, but it will apply to 2023. So if you have a calendar year tax year, the statute will take effect. You'll be having to report and file returns with regard to your fiscal year that begins, in that case, the 1st of January 2024, and then file returns and pay taxes within 9 months of the close of your financial year. And my colleagues Thomas and Jishan will give you details of those timing requirements. But the law very much is in effect. It's being amended supplemented, I should say, by regulations on a frequent basis. The most recent official gazette that I saw a couple days ago has some yet more regulations that have come out. So like Zahir said, it's very much a moving target, a changing target. It's a new area of law, and you'll either be fascinated or chagrined, depending on your point of view, by this new feature of the landscape. So number one, who is covered? It is a business law. It is a business tax. That is, it covers natural persons who are doing business within the UAE. So if you're a muassasa, a sole proprietorship, and you're licensed to engage in business activity in the UAE, your business will be covered by this tax law, and you will have to file returns and pay tax. A corporation, a corporate entity established in the UAE is likewise going to be subject to the new requirements of this new law. Now, foreign entities will as well. if they have a permanent establishment in the U.A.E, which basically means a license or some kind of business presence here. So basically natural persons who are doing business, corporate persons doing business, locals and foreigners, they're all subject to the ambit of this new tax law. So it's going to really very much change the landscape here. Along with the question of who will be covered is the question of who will not be covered. And I know that Jishan is going to give some detail on this, but there are 9 categories of exempt entities that are not going to be required to file and pay tax under the new tax law. These include government entities, entities involved in extractive activity, oil producers, people like that, qualifying investment funds, pensions. I'm going to let Jishan in a few more minutes get into the details of those exemptions, but they're very much an important part of this statute. Bear in mind as we talk about these subjects that a number of entities you hear mentioned that may not pay tax doesn't mean they're exempt. It means they have a 0% tax. And there are quite a few of those as well. Small businesses, various other entities, free zone entities qualify at a 0% rate. They are not exempt from the law. They still have to file, report their income, keep their accounts the way you're supposed to, do all that stuff that again, Thomas and Jishan are going to be talking about in more detail. But the effective tax rate for income earned by those taxpayers will be 0 as opposed to 9. And that gets me to my last point. What are the rates of taxation? Again, for almost everybody I mentioned, it's going to be 9%. But there are some taxpayers will be able to pay a rate of 0% based upon the kinds of income they are earning. For example, small businesses, for example, some free zone entities, and so forth. There is a cutoff income, and so if a business is earning the amount of dirhams 375,000 per year or more, then that triggers the 9% tax threshold. But below that amount, the rate is 0%. And there are a couple of interesting features. Unlike other tax laws in some other countries, there's no withholding against payment of funds overseas. There's no tax on dividend payments in general. And again, I think Thomas is going to address those subjects. But that's the big picture. It's effective now. It applies to businesses, foreign and local, if you're doing business in the U.A.E. And the tax, the headline rate of taxation is basically 9%. Although some taxpayers will be paying 0%. And I think with that, I want to pass the torch on to, I think Jishan is next, is that right?
Yes, yes. So I'm gonna thank you, Charles, for that introduction into the subject and kicking us off. Jishan, thanks for being with us. Jishan, tell us, how are people calculating their tax base? And we just heard Charles say something, corporate person and natural person. And what are these terms that people should be aware of? And Charles also discussed exemptions from corporate tax. So who are the groups who are exempt from corporate tax?
Great. Thank you so much, Zahir, and thank you all for joining this wonderful event. So again, I think I will start with the topic of taxable person. So if we can move to the next slide and show, yeah. So basically, the tax legislation in U.A.E has segregated the taxable person into 3 categories. I think Charles has explained some of it in detail, but again, so starting with the residential person. So a resident persons it could be either a juridical person or a natural person. But again, I think the more highlight is on the juridical person. So when it comes to a juridical person, so a juridical person which is established in U.A.E or recognized in U.A.E as per the applicable laws and regulation. For example, it could be even an LLC company or even a public joint stock company. So if you are incorporated in U.A.E under the applicable laws of the U.A.E, then of course you will be treated as a taxable juridical person, okay, a resident person. And we have some companies which is basically established outside the UAE in a foreign jurisdiction, okay, but these entities might be controlled within the UAE. So basically, the companies are established outside the UAE in a foreign jurisdictions, but the control of them and the management of the entities might be from the UAE. In this case also, those entities, although they are established in foreign jurisdiction, but they will be treated as a resident in UAE for the purpose of corporate tax. So this means that having a company outside the UAE, you will not be eligible to be a resident in UAE. You will be. You need to understand, and there are different aspects that the tax authority might look into to identify the control from UAE. Okay, and of course, we have the natural person, but before we go to the natural person, it's better for me to explain what a non-resident person and how a non-resident person will be eligible for tax in UAE. Now, a non-residential juridical persons are those which is incorporated outside the UAE, but they might have a permanent establishment in UAE. There are a list of permanent establishment. It could be a factory, it could be an office. So you are a company incorporated outside the UAE, but you might be conducting business activity through a permanent establishment in UAE. If that is the case, then you are a non-resident person for sure, but you will be eligible to report tax in UAE. Okay, you will be treated as a taxable person in UAE. Or a second, the second category in the non-resident person is if you have a nexus in the UAE. I think recently a cabinet decision has been issued to explain that if you have an immovable property in UAE, or I would say that if you are earning income from an immovable property in UAE, although you are a foreign company, but you own an immovable property and you earn revenue from those immovable property, in that case, you will be treated as having a nexus or a permanent establishment. Then you will have to basically report for tax in UAE. So these are the two main category of taxable persons, especially when it comes to juridical person, either a resident person or a non-resident person. And we have a third category of qualifying free zone. I think later in this presentation, we will have Charles explaining regarding the qualifying free zones. Now, again, I want to highlight on one thing as well. For example, a resident persons include free zones as well. For example, if you are a company incorporated any of the free zones in UAE, you will be treated as a resident person unless you are a qualifying free zone. We'll come to that point later when Charles explained the qualifying free zone. When it comes to a natural person, Charles explained earlier that a natural person who is conducting a business activity in UAE will be treated as a resident person. But a natural person has a lot of exceptions as well. For example, sole proprietorship is one of the categories. So you have a sole proprietorship company, you will be also treated as a natural person in UAE. But there is a threshold limit. For example, if you are deriving a revenue of less than $1 million, then you don't need to be report for tax. You will be treated as an exempted person. So you don't need to basically register or report for tax if you are a natural person and you are conducting a business activity and your revenue is less than $1 million in a tax year. Okay, in that case, you will be completely exempted from the tax. Okay, you don't need to register or report for tax. On the other side, natural person, if you are deriving your wages or if you are getting wages from a company, it won't be eligible for taxation. You have a personal investment, you won't be eligible for taxation. Or if you have a real estate investment and you are earning revenue from the real estate investment under the personal capacity, you will not be eligible for tax. So there are big difference of holding investments under personal capacity and under the capacity or under the juridical person. So if you can go to the next slide, I can explain more in terms of how the tax rate will apply. So basically, Charles explained earlier as well that we have a threshold limit of 375,000. So if you are a resident person or a non-resident person, the application will be same. The threshold limit will be same. If you are a taxable person, then you have to pay 9% in excess of the 375,000. So if your taxable income is below 375,000, then there is no requirement or to pay tax. Of course, you need to report for tax. You pay 0% tax. But on the other side, once the moment that your revenue exceeds 375,000, any amount exceeding the 375,000, you will have to pay 9% tax on it. Okay, so having a revenue below 375,000 doesn't mean that you are an accepted person. It simply means that you have to pay 0% tax, but you still need to report for the tax. If you can go to the next slide, to the final thing. So again, I mentioned earlier, the 375,000 limit is applied for a taxable income. A taxable income does not mean a revenue. A taxable income means something similar to accounting profit. So you have an accounting profit, so you have to make some tax adjustment. There are allowed adjustment as per the tax law. You make some adjustment, plus, minus, and you finally end up calculating the taxable income. So don't kind of misinterpret the word income against the revenue. Somehow different. It's something starting with the accounting profit. Somehow it's similar to the term profit itself. If you can go to the next slide. Yes, so we have limited number of accepted person as per the tax regulations, and I don't think that many of those companies will not fall under these categories. So we have government entity. Of course, government entity, they don't need to pay for or report for tax. It's like putting the money from one bucket to another bucket. So there's no point of reporting for corporate tax. Government controlled entity. Similarly, you have an entity which is completely controlled in the state, controlled by the government. Then of course you don't need to report for tax. Extractive business basically those business which is involved in the extraction of natural resources in U.A.E. will not be eligible for corporate tax. Non-extractive natural business, basically those are kind of business which is supporting the extractive businesses, doing the marketing and distribution activities for the extractive businesses. Qualifying public benefit entities, of course, the government need to promote the public benefit entities. It includes those entities which are there for social benefits, for religious benefits, for cultural benefits. They will be completely exempted from corporate tax. Qualifying investment funds, of course, government need to promote the investment. So qualifying investment funds, I think recently we have cabinet decision issued detailing the qualifying investment fund as well. Private or public pension or security fund, they are all for public benefits, and those other categories which is controlled by government entity, government controlled entity, qualifying investment fund, and private public fund. So it's a kind of a list of exempted entities. I think going through the presentation, I will leave it to the next slide.
Yep. So thank you, Jishan. Thanks for getting us further into this subject. I just want to let everyone know is like, as they're seeing these presentations, a few people have come in, is that this presentation will be available online after. So don't worry if you're scribbling down notes or some of the concepts are flying past you. You have a chance to look back and review it again. I'm going to call upon Thomas now, and Jishan sort of mentioned this right now, with respect to small businesses and people who are exempt, but there is something called a small business relief. And Thomas, what is it exactly? How much is it? And what are the stipulations for applying it?
Yeah, thank you very much for passing on the proverbial microphone. The small business relief is indeed a relief applicable to small businesses, as the word itself says. However, it's a temporary relief, given that it only applies until the 31st of December 2026. So this helps small businesses ease into corporate income tax up until that point. Important as well is that there's a revenue threshold. It's very important to stress this is it's revenue, not profit. And therefore you might relatively quickly hit that level. This needs to be seen further in terms of the structure and into the other categories that have been described by the other speakers earlier today as well, because we'll essentially have a couple of tiers which apply, and for businesses in the U.A.E, depending on your size, slightly different options will be available and slightly different compliance obligations as well. I'll be speaking later on about transfer pricing. And we don't really have the time to go much into those tiers. But for example, also below 3 million dirhams, you're allowed to use cash accounting rather than your normal IFRS accounting norms. What is not available in combination with the small business relief is a whole range of exemptions, which the other speakers are going to be talking about, reliefs and concessions, such as, for example, certain exemptions of the income. We cannot exempt the same income twice, obviously. There are certain deductions which are not allowed for small businesses, and neither is if you run a loss. For example, you've got expenses worth 4 million, but revenue 3 million, that puts you into the bucket of small business relief. You cannot roll forward the losses, whereas if you're a normal business, you can. And I think that the important message is with small business relief is that you really analyze what are the advantages and the disadvantages. Yes, you will not pay any corporate income tax, but there's a whole range of other things that you might not be able to avail. And if we go on to the next slide, you can already see two categories which are simply excluded from the benefit of small business relief. The first one being any entity which is a constituent company, part of an M&E group. This might not ring a bell to many, but this is a term which is referred to, or which refers to a local entity in the UAE, which is part of a global group, an international group, which has a global consolidated turnover in excess of 750 million euros. This is this global minimum tax that a lot of people have been talking about. Yeah. If you have a small entity in the UAE, but you fall inside the scope of the global minimum tax, you cannot benefit from small business relief. And the second one is what is termed as the QFZP. The other speakers have talked about this, but will talk about it in a bit. Charles is going to detail a bit the QFZP regime. It's not an easy one, so I'm happy that he's doing it instead of me, but I'm happy to take the questions later on. And so what is probably important for the small business relief, back to that, is indeed no carry forward of tax losses, whereas under the legislation you can carry forward your tax losses and compensate up to 75% of future profits. And when it comes to the 30% EBITDA limitation for net interest expenditure, normally speaking, you can carry this forward for 10 years. But again, if you fall inside the scope of small business relief, then you cannot. And finally, before I hand back the mic, there is, for those of you who have thought, let me go and split up my business into several small businesses, the FTA has the right to recharacterize those multiple small businesses into one bigger business if they feel that the separation of those several businesses is artificial. It doesn't need to be read together with what the other speaker said around the exclusion, for example, for natural persons of investment income, real estate income, wages. So it is something to be considered as well, because you could also be benefiting from other from other reliefs. I think Charles is already pitching me a question specifically on this. Yeah, if you ever go over the 3 million dirhams in terms of the revenue in any of the years up until 2026, you lose the benefit entirely, and you cannot go back. For example, if your revenue drops the next year. I'll hand back to Mike.
Thank you, Thomas. It's thanks for detailing some of the rules behind taking on this SBR program. It's important to note that this is available for a limited time at the moment, and there are some these important stipulations that people need to be concerned about before they opt in. Of course, everyone will be looking at with respect to what we want to come into compliance and want to comply with the law as best as possible, but we want to look at avenues on where we can reduce our tax base or maybe optimize it. that being, Jishan, if I can call upon you, and can you sort of tell us a bit about sort of the deductions people can make, the tax loss or credit that Thomas touched upon as well, and what expenses can people sort of remove from their taxable base, such when they're calculating this taxable amount?
For sure, Zahir, I think that's an interesting question that everybody is looking for an answer. Now, yes, I mean, tax authority has made it very, or tax legislation has made it very simple that almost all the expenses, which is wholly and exclusively for the purpose of business, and this is two important words they have highlighted, wholly and exclusively for the purpose of the business. So if you are incurring any expenses for a taxable business, which is wholly and exclusively for the purpose of the business, those are deductible. Okay, there are some exceptions to it. If you can go to the next slide, I can just explain. So a limited number of exemptions, other than it's all very simple. Interest expenditures are deductible, but there are limitations for it. 30% of the accounting profit, which again, if there is any excess, you are allowed to carry forward it to the next 10 years. Entertainment expenditure, basically, as per the tax authority, they mentioned that there is a kind of personal benefit to it or personal enjoyment to it. So entertainment expenditure, especially to the external parties, are allowed up to 50%. Okay, now entertainment expenditure to the employees are completely allowed. I'm just talking about entertainment expense to the external parties. Expenditure for deriving exempted income. For example, if you have a business doing both exempt and a taxable business, so those proportion of expenditure related to the exempted business will not be deductible for the purpose of corporate tax. And there are a few list of non-deductible expenditure, including fines, bribes, and some gifts, especially to non-qualifying public benefit entities. So they made it very simple, and it's very kind of almost all the expenses are basically deductible for the purpose of the tax, including they have also allowed the expenditure or the payment to the connected party as a deductible expenditure. We can go to the next slide. Yeah. Now, coming to tax losses, this is another deductible when it comes to corporate tax. So, for example, if you have tax losses which is incurring during the current year, you are allowed to carry forward to the upcoming years. There is a limit. A limit is actually 75% of the taxable income on the upcoming years. But of course, you are allowed to carry forward the tax losses. So basically, if you have reported any tax losses, you are not going to lose anything. You can use them in the upcoming years as well. And again, if you can go to the next slide, there are another use of tax loss as well. For example, if you have a qualifying group, an entity between the qualifying group can transfer the tax losses to offset the taxable income. Now, for example, qualifying group is with a threshold of 75% ownership. Either company A owns 75% of company B, or they both have a common control of 75%. In these two cases, you are allowed to transfer the tax losses between the entities, and you can offset the tax loss from one company against the taxable income of another company. Yeah, I think that's it with me. So I will hand over the mic to the next presenter.
Yeah. Thank you, Jishan, for that. And I just want to take a moment to answer some questions that have come in, or if anybody had any questions. I think we had one from Jesse Almur. Jesse, thanks for joining us. Your question came in asking, do U.S. citizens who own small businesses based in U.A.E. have to double file, as in filing income taxes in the U.A.E. and in the U.S.? So Thomas, your international tax, this is your field. So what an American have to do? How much more tax do we have to pay?
It's not a quick answer, but let me try and give a couple of observations. So the first observation is there's no double tax treaty between the US and the U.A.E. That may sometimes be harmful, but not necessarily, given that the US would give a unilateral credit for taxes paid abroad, despite the fact that there is no double tax treaty. I will say whether you're going to be paying in two countries or not depends on a number of situations. So the first thing is, as a small business owner, are you a self-employed person, or do you have a legal entity, right? If you're a self-employed person and you're running that business from the UAE, then you should be paying corporate income tax in the UAE. You may benefit from a couple of these reliefs, such as small business relief, for example. If you're a corporation in the US, and as Jishan was saying, your place of effective management is actually in the UAE, then the UAE is going to consider you as a UAE tax resident. In that case, yes, you will have filing obligations in the US, and you will have filing obligations in the UAE. And there will be, given that there's no treaty, there is no tiebreaker rule to put you in either of those two countries. So that would be not the most ideal situation. Another thing that could happen is if you're a US corporation, but you effectively have a PE in the UAE. We have a PE in the UAE, something that Charles was referring to before. You would be subject to UAE corporate income tax. However, the US would allow you on a federal level to credit foreign taxes paid subject to certain conditions. So I know it's not a short answer, but it gives you a couple of thoughts on it, I'd say.
Yeah. Yes, Charles. Your hand is up. Yeah,
please.
Just
I wanted to add to that because I'm an American taxpayer, so I feel for you. I know what it's like. If you own a business overseas, you've got a separate form to file with the IRS when you file your annual 1040 and all that. Of course, you can claim a deduction, a credit for foreign tax paid. You can claim an exclusion for foreign earned income if it's foreign earned income. But if you do have ownership of a business, there's a separate IRS form to pay. It's a big one. File. It's a pretty thick form, and there's a big difference between if you're a controlling or non-controlling shareholder. So don't forget that you've got U.S. as a U.S. taxpayer, U.S. filing obligations, and UAE filing obligations, and the U.S. authorities are not to be fooled with. They take their job very seriously, and so don't forget, don't miss a filing deadline over there. But yeah, it's enormously burdensome for Americans doing business outside of the United States, and no one seems to care. In Washington, they don't care about that, but it's a huge burden.
Yeah. Yes, Charles, thank you. And I do feel Charles's pain at the end. As AmCham, we've actually gone as a group to advocate for these sort of policies that make it more difficult for Americans to live, work, and do business abroad. And he is correct that first, it doesn't translate to a lot of votes, our message. So that's why it gets put aside. So, but that being said, Jesse, I hope that this is helpful. One thing I think you can take from this is don't go it alone. Do speak to an advisor as you're sort of trying to figure out your compliance. We have a question from Jessa, and the question is saying, group is 75% or should be 95 for a controlling interest. Thomas, I think this is with respect to like. If you can take this upon, what is defined as controlling interest when we're with relevance to the corporate tax law?
Yeah, so there's essentially two types of groups. Yeah, there's the group that allows you to constitute a tax group, which means that you consolidate all of your revenues and expenses between all of the members. That is something which is only available within the UAE, within UAE entities, which are indeed commonly held and commonly controlled, 95% or plus. But even below that, and this is the point that Jishan was making before, is there are certain reliefs available for groups, and one of them is indeed that you can transfer a loss from one entity to another. This shows a bit that the UAE system is very flexible, and this is we didn't really touch upon that much in the introduction, but this is not an exercise to get in more revenue. This is an exercise to provide the first stepping stone towards the implementation of that global minimum tax. So the 75% indeed gives you certain benefits, the transfer of losses, the transfer of assets between group members, but it's not a consolidation. Only 95% plus is a consolidation.
Thanks, Thomas. I'm going to take on another question, and then we'll continue the presentation. We have Malik. Thanks, Malik, for your question. How can we separate revenue and expenses if you have branches both in free zone and in mainland, and customers both in free zone and mainland? Yes, Thomas, what can you say to this sort of compliance conundrum?
Sure. And this is not an easy thing. Yeah, I think that's the first thing, and it will always be debatable and subject to disputes with the tax authority. However, what the principle says and what the U.A.E.'s federal tax authority is going to be applying is something that we call in technical terms a separate entity approach. When you have a free zone entity, a QFZP, subject to 0% and a mainland branch subject to 9%, there is indeed that matter of how do we split it between the two. And the separate entity approach says that you need to allocate profits to the mainland branch as if it is a completely distinct entity. That's a good principle to lay out there, but it's not an easy one to apply. And the way to apply it then subsequently, according to the recommendations of the OECD, which the U.A.E. is going to follow, as well as we need to follow transfer pricing rules. Yeah. What we're going to have to do is we're going to have to do a study where we see which potential methods would apply, what benchmarks are out there, what potential safe harbors that we can apply. I know those are all a lot of technical terms, but the sum of it is that you essentially need to pretend as if the mainland branch or mainland PE for that matter is a completely separate entity. And that applies irrespective of where your customers are located. Back to you.
Sure. Yeah. Thank you, Thomas. And with that, we're going to go into, as we're getting more complicated, we're going to get into some further complications, but please bear with us. We're going to be going into the topic of free zones. And I think this is a subject that everybody is very much concerned about. You either do business in a free zone or doing business with a free zone. Perhaps you're looking to set up a free zone entity. It is important to know what is the rules for corporate tax within the free zones. So Charles, there was this thing that Jishan mentioned, a qualifying free zone and non-qualifying free zone. So help demystify it a little bit to everyone here so they can start understanding this slightly complicated rule structure.
Yeah, go to this next slide. No, the other way. Here we are. Okay. Yeah, we've got some alphabet soup here like usual in tax codes. And I'm not sure I'm going to, I mean, Malik's question is very good. It's the difficulty isn't so much the rules, but applying the rules to a specific fact pattern. And I'm just going to go through the rules here. Now, what Thomas mentioned, the QFZP, a qualifying free zone person. What is that? Okay. But basically, I'm going to answer that question in a little bit, but basically, a qualifying free zone person that receives qualifying income from qualifying activities pays a tax of 0%. So it's a good thing, right? But then what does it all mean? A qualifying free zone person is going to be a company that is established in one of the free zones. It maintains, you know that there are these economic substance filing regulations in the U.A.E. You've got to comply with those. You've got to have adequate economic substance in the free zone. You've got to derive qualifying income, which I'm going to get to in a bit, from within the free zone. And you have not elected to be subject to the corporate tax under other provisions of the tax law. So it's basically, again, conceptually, a qualifying free zone person is a taxpayer located in one of the free zones receiving, again, qualifying income. What is qualifying income? That's the big question here. And qualifying income kind of breaks down in two ways. It can be income that is derived from transactions with other free zone persons, except for income derived from excluded activities. And I'll get to those in a little bit. Or it can be income that's derived from transactions with a non-free zone person, but only in respect of qualifying activities. Okay, so that gets me to the qualifying activities. Qualifying activities, there are 7 of them. And again, these are the kind of business activities that a qualifying free zone person will engage in the free zone. Manufacturing, processing of goods or materials, holding of shares or other securities, ownership, operation of ships, regulated insurance and fund or wealth management. Sorry, reinsurance. Headquarters and financing services for related parties, financing and leasing of aircraft, logistics, and distribution of goods. Okay, that's a bit of a summary. I've cut out a little bit of excess verbiage, but that's the concept. If you engage in one of these activities in the free zone, those are qualifying activities. And so the income arising from that activity would be subject to a 0% rate if it's earned by a qualifying free zone person, unless the qualifying free zone person is engaging in excluded activities. Okay, excluded activities takes you out of the first type of qualifying income, which is income derived from transactions with other free zone persons. It also takes you out of qualifying income defined as income derived from transaction with non-free zone persons arising from qualifying activities. Okay, so excluded activities. There's 7 of those as well. Transactions with natural persons, except for transactions linked to qualifying activities. There are banking activities, insurance activities, financing and leasing activities, ownership or exploitation of immovable property, ownership of intellectual property assets, and then other activities ancillary to the foregoing. So again, if you are a qualifying free zone person earning qualifying income from qualifying activities and not from excluded activities, then you get to report 0% tax, 0% tax on your qualifying income. But some types of income are not going to satisfy this. So you could have a situation like I think Malik was getting to, where one taxpayer will have some income tax at 0% because it falls into these exceptions for free zones, but some will not qualify, therefore it'll be at 9%. Okay, that's the sort of conceptual framework as I see it. And for individual businesses, it can get quite complex. And if you elect to be in a group or something like that, you won't qualify for this qualifying free zone person treatment. And there are certain other exceptions as well, besides just the exceptions for excluded activities. So that's the big picture. I don't think we can get now. Thomas or Jishan might disagree, but I don't think we can get into giving Malik or anyone else specific advice on their situation that they're facing. But it's going to be largely an exercise for each person distinguishing what income is going to be taxed at 0% and what income is going to be taxed at 9% because of these various criteria that are set out in the tax code. Does that make sense? Or is it,
I think
does it raise more confusion?
Yeah. If you can just say qualifying free zone person, qualifying income, qualifying activities faster, let's see how go with that tongue twister.
Well, that's the conceptual framework, but the devil's in the details, right?
Yes.
And so you've got that's why when you get into the nitty-gritty of a specific taxpayer situation, it can get very complex.
And we have a question that's come in, and we'll take that up as well since we're on this subject. But perhaps one of the speakers could talk about the de minimis rule with respect to the categorizing yourself as a qualifying free zone person. Did anyone want to take that?
I'm happy to. Or
Yeah. Go ahead, Thomas.
So the de minimis can be summed up as I call it the 5 and 5 rule. You're allowed to have excluded activities or non-qualifying activities up to 5 million dirhams of profits, or up to 5% of your overall, 5 million dirhams of revenue, or up to 5 million, 5% of your overall revenue. So it is designed in such a way that you can look at what is potentially ancillary, and what is ancillary does not push you out of the QFZP status. If you go beyond the 5 and the 5, so the 5 million dirhams of revenue, the 5 million percent of non-qualifying or excluded activity, you lose your benefit for the current year and the 4 next years. So it's quite heavy. There's a couple of exclusions from that calculation, for example, real estate, and also mainland and foreign PEs you need to exclude from that calculation. Yeah, this is done in part to help businesses that maybe, just have incidental revenue from this. Maybe I'll take Bashir's question as well.
Yes, please go ahead. Yeah. I'll read it out for you here. So Bashir asks, does qualifying free zone mean those free zones which have tax exemption for a number of years versus those free zones which do not have tax exemption and hence called non-qualifying free zone?
Yeah. So Bashir was actually one of our students in our GCC tax certificate, but at the time this was not known yet. So I think the first thing to know is, yes, the IFC, ADGM, a whole range of other free zones have a tax exemption, sometimes based on legislation effectively, whether that's local emirate legislation or federal legislation. But in effect, with this law, that goes potentially out the window. So I'm afraid that tax exemption in the law loses a bit of its value. Yeah.
Right. Thanks, Thomas. We're gonna move to the next topic as we keep moving. I know people do probably have some questions, and you can put that into the chat box. We'll have a chance to answer them at the end. Could I call upon? I think this is the subject for Thomas again here. The capital gains, dividends, and foreign permanent establishment. So some of the rules with respect to these topics.
Happy to take this on. On this topic, it demonstrates that the U.A.E. tax framework is very, again, lenient. Overall, your effective tax rate will not be too high due to all of the reliefs, but also the U.A.E. has looked very good at the position that it occupies in the region as the regional hub, the place for regional headquarters, the place for holding companies. And for that last bit, the dividends and capital gains regime is very, very important. When you're a holding company, you want to establish yourself in a location that has a very good holding company regime, and the participation exemption contributes towards that. So how does it work in the U.A.E.? Dividends and other types of other profit distributions are fully exempt from corporate income tax in two situations. Number one is when they are received from another U.A.E. resident person, a juridical person, irrespective of the level of ownership and irrespective of the location also of that entity. That means that you can be earning that income from a QFZP, for example, and yet have the dividend exempt in the hands of the beneficiary of those dividends. But also, when it concerns investments abroad, there's also an exemption for dividends. And on the next slide, in a minute or so, we're going to be detailing those conditions. But so that means that any capital going out in terms of investment out and dividend back, that we will have also an exemption for those dividends received. The law also says that there's no deductions for payments of dividends, but that's for tax people logic, and dividend is what you pay after tax, not before tax. And the exemption for the dividends is also the framework for that, for when it comes to foreign shareholdings, also applies to capital gains. So any kind of sale of shares as well, whether it's in a U.A.E. company or in a company abroad. If we move to the next slide, you will see the conditions for the application of the participation exemption for dividends and capital gains earned by a U.A.E business from a qualifying foreign shareholding. You can see them in front of you. There's a minimum participation required of 5%, which doesn't apply locally, or an acquisition value of 4 million dirhams. So you may hold less than 5%, but the acquisition value is 4 million dirhams. That means that you tick the first box. What we're after is not only a substantial participation defined as 5% of 4 million, but also a long-term holding of those shares. And this is what the second condition seeks to translate, which is you're holding or you intend to hold those shares for more than 12 months. That means that for you, it's an asset. It's not shares that you're trading with, essentially. That's the major distinction that we make. A following one then is that the subsidiary in which you hold the interest needs to be subject to at least the same level of taxation as the U.A.E. So that means a statutory rate of 9% or higher. That is usually fine in terms of this requirement, because there really aren't that many jurisdictions that have a CIT rate below 9%. But even if they do, and for example, it's calculated on a different basis, such as Saudi Arabia, for entities which are held by GCC nationals paying zakat, you can recalculate the taxation of that entity according to U.A.E norms. And if you get to 9%, according to U.A.E norms, then you would also tick that box. Then the final one is something that relates to we call a specific anti-avoidance rule, which is that the revenue earned from by the entity in which you are having the participation cannot constitute of more than 50% of revenue which would not qualify for the participation exemption if it were held directly. So that's in terms of dividends and capital gains. And if we move to the next slide, we'll talk a bit about PEs and credits. This is also a bit of a complicated area. Again, here quite some flexibility built in. The default rule from a U.A.E perspective, domestic U.A.E perspective, is that we grant a credit for foreign taxes payable. Why am I stressing domestic? That is because under certain double tax treaties, the U.A.E may negotiate that a different method applies for double tax relief. The U.A.E domestically, and then most treaties, at least the ones that I know, would apply the credit method, but it wouldn't give a credit unlimited. It would apply something called the ordinary credit system, which means that it would allow the credit to be offset against the domestic taxes paid, but only up to the effective taxes payable abroad, or the taxes that would be payable in the U.A.E on that same profit. So there's a cap on that. There's a cap on that, and there is no refund or anything for foreign tax credits. There is potentially in the future for withholding taxes when it will be applicable. In addition to this, though, when you have a U.A.E entity and it has a permanent establishment abroad, instead of having the credit applied, it can elect to apply an exemption of the profits earned by the PE. It comes with a couple of conditions, amongst others that the PE needs to be subject to at least 9%. Again, and when that happens, I'm going to be completely excluding any revenues or losses from the foreign permanent establishment. This is essentially the credit and the exemptions are ways of avoiding double taxation, because in the U.A.E, we tax on a worldwide basis. And that means that when we earn income from abroad, whether that is through a PE or simply through service income, which is subject to withholding taxes, the U.A.E is going to unilaterally provide a credit for this in order to avoid double taxation in the U.A.E. That meaning taxation of income earned from the U.A.E and income earned from abroad. I think we can move on.
All right. Thank you, Thomas, for detailing. This is also, once again, fairly detailed discussion is needed further. It depends on everyone's different businesses, but thanks for giving your best shot at giving it an overview on this. From that, we're gonna come back into the subject of tax groups. And we touched upon it. This was mentioned earlier in the presentation, the idea of a tax group and how to form a tax group, what qualifies. We had a question on it as well. Jishan, can you discuss the concept of tax groups? Is this the same as what we have in the VAT? Because we have VAT tax groups, so help us understand how it works on the corporate tax side.
Yes, thank you, Zahir. I think it's actually completely different from those we talk about the VAT tax group. So I think there are conditions. For example, the tax group in the corporate tax can be formed between a parent company and a subsidiary. Now, for example, in the VAT aspect, you can have a tax group with a common ownership of more than 50%. But here, a tax group can be formed between two taxable persons, and it has to be between a parent company and a subsidiary company owned by a parent company. And there are certain conditions to it. For example, 95% ownership is mandatory to form a tax group. Again, it cannot be formed. It has to be a resident person, and both the members of the tax group must be resident, juridical person. Then they should not be formed between an exempted member or a qualifying free zone person. They should follow same financial year. And that's one important point that I want to highlight as well. Like when you are choosing the financial year during the registration time, and if you have any intention to form a tax group, you should basically opt for same financial year for both the members. So when it comes to VAT tax group, the tax group in the corporate tax law is it's entirely different, and there are benefits. For example, once you are forming a tax group, ultimately you are trying to form one single taxable person. So you might be getting only the 375,000 limit for one entity, basically for both of them together. I don't think you can get 375,000 for subsidiary and a parent company. So it might be consolidated to 375,000. And of course, the benefit is that you don't need to basically transfer the losses between the companies. You can consolidate them. You can prepare a full financial statement, consolidating them together. There is no transfer of losses or income between the entities. So consolidating is a mandatory rule in terms of the tax group. Again, the main concept of forming the tax group is that you need to analyze it well. It's an option whether to form or not a tax group. So better you need to have a proper impact analysis before you plan to form a tax group. Yeah, you can go to move to the next slides.
Yes, thank you, Jishan, on telling us what are the rules for forming the tax group. And yes, organizations should look at themselves on how that would benefit them, or perhaps may not. So they have to see how it works for them. Everybody has to study that, and it's important for someone to do an impact assessment if you choose to join into a tax group. Now, as we know, in the UAE over here, there's a lot of organizations that related parties that do business with each other. And this sort of brings upon the idea of transfer pricing. This touches upon transfer pricing. And Thomas, could you tell folks what does transfer pricing mean, and how does it work in terms of for UAE corporate tax?
Sure, yeah, happy to. Thank you for handing back the mic. Transfer pricing is a concept used for tax purposes to designate a framework under which businesses that do business with related parties need to apply the same commercial terms as when they conduct business with unrelated parties. That's the easy principle to understand and explain. The not so easy one is to apply it. And in the UAE, it has a fairly broad scope in the sense that it also applies to government entities. It is a requirement for you to apply the QFZP regime for free zone entities that you conduct your transactions at arm's length. In addition, indeed, to what you were referring to indeed a bit earlier, Zahir, which is, you know, the UAE necessarily is a beautiful country, but it's a small country, but it's extremely well connected to the rest of the world. So that means that necessarily we will have a whole range of intra-group transactions. And those transactions, they need to meet something called the arm's length principle, or the arm's length range. And the arm's length range is just stating the exact same as what I explained a couple of minutes ago, which is whoever is closer to you in terms of control, so who's a related party, you need to treat them as if they are further than an arm's length away, really. Couple of good things on this is that the UAE is not going to reinvent the wheel, and therefore it will apply OECD transfer pricing principles. We saw in the region, in the other GCC countries, that from time to time the countries take slight deviations from this. So far we have not seen that. So it is our expectation that the UAE will act like Ireland, for example, which has just adopted it wholesale into its internal legislation. That also means that businesses that are doing business internationally, they can rely on these principles, and they can expect a certain framework to apply. Two other things that are noteworthy mentioning in terms of the application of the transfer pricing principles is something called, and again, excuse me for the lingo, corresponding adjustment to prevent double taxation. What does this mean? This means that when we have a transfer pricing framework which applies internationally, there's always one loser, one winner on this. And that means that we always have two sides to a transaction. And if as a group you get audited in another country, and in this other country the tax authorities of the opinion that the profits need to be higher in that country, then that might mean that your expenses in the UAE need to be lower when that entity is doing business with the UAE. So the UAE is going to allow such corresponding adjustments to prevent double taxation. And that's a principle in the law. We know again of experience that that's not always going to be easy to apply. Another very good feature is, we haven't touched upon this much, is the ruling process, which for TP purposes is going to result in something called an APA, or an advanced pricing agreement. Before you conduct your transaction, before you implement your framework, you can discuss with the authority and agree on a benchmark, agree on a method, and agree on a profit allocation. And I would definitely recommend everybody to do that as well. We have a quirk as well in the UAE legislation, which is lumped into transfer pricing, but is perhaps not exactly the same thing. And that's the concept that you see at the bottom of the slide of connected persons. Connected persons are people who could exercise control over an entity and perhaps artificially inflate their own remuneration. So there's people who hold a certain function in those entities. It could be managers, directors, shareholders, or relatives thereof. And what we see there is that the UAE requires that when someone potentially has that control, or knows someone that has that control, is paying him or herself a salary or any type of benefit for that matter, that needs to be justified with transfer pricing principles. So it means that if you have a purely privately held entity and you're the 100% shareholder of it, you cannot simply reduce the taxable profits of that entity by paying yourself a salary which is 3 times higher than the one that you paid last year. Yeah. Again, I'm slightly oversimplifying, but you probably get the concept. If we move to the next slide, we've put onto a table what the different disclosures are that you will be required to do from a transfer pricing point of view. One is a disclosure form, which not all countries apply. Maybe half of the countries around the world that have TP apply this. In that disclosure form, which is common in the region, Saudi has it, Qatar has it, you will report specific transactions above a certain threshold with related parties, and in the case of the UAE with connected persons as well. That it will be filed together with the CIT return, and that is something that the tax authority bases itself on to conduct audits. Two other obligations are the usual suspects from a transfer pricing point of view. But why? Because they are OECD standard. And those two documents are called master file and local file. Master file is what you keep at an HQ level and has the high level overview of the group with a bit of detail that you see in front of you. The local file is something that will be new in the UAE, because that local file, there is no obligation, or there was no obligation until recently to have that local file. So that local file has more detailed information for locally in the UAE, what transactions you conduct, how you did your benchmarking, and what are the rates that you are applying. Good thing in the UAE is that you don't have to submit it together with the CIT return. Whenever there's an audit, you got 30 days to do it. I would definitely recommend all of yourselves not to wait for the audit, because 30 days is never long enough to actually conduct the whole analysis and put together a local file. But luckily, there is a threshold below which you are not required to draft up the MF and the LF, as we call them. That threshold is put at 200 million dirhams of revenue in the UAE. If you have more than 200 million dirhams of revenue in the UAE, or again, if you're a constituent entity of a Pillar 2 company, a P2 co, then it will be compulsory for you to have that local file. No formats announced just yet, but we expect that the UAE is simply going to apply the OECD format. Back to you, Zahir.
Thank you, Thomas. Thanks for highlighting the importance for this transfer pricing documentation and why companies need to start looking into building their transfer pricing policies. We have about less than 20 minutes left, and I just wanted to work towards our last topic, and that is with respect to the compliance of filing the tax returns and payments and deadlines. Jishan, if you can quickly tell us what are people going to be filing, what are their deadlines, and how they will be doing that.
Yes, if you can show the slides. Yeah, I think I need to run from start to the finish now. So the effective date of corporate tax in UAE is from 1st of June 2023. So the tax reporting is based on the financial year of the company, financial reporting year of the company. So any company having a financial year starting after 1st of June 2023, they will be subject to tax from the date that the financial year starting. For example, I have given example of those company. Usually in UAE, people they use the financial year from January to December. So for those companies who starts their financial year from January, so their financial year will be starting from the January after 1st of June 2023, which is basically starting from 1st of January 2024. And they have 12 months financial year. That's the usual tax period of 12 months. So in some cases, you might have short or long tax period. But in usual circumstances, it's a 12 months tax period. And you have 9 months after that to file the return and make the payment. That's a very important thing that, for example, you have 12 months period where you complete all your transaction, you record your books, you clean your books, but the 9 months period is what you have for reporting, filing the return, and basically making the payment. Okay, when you look at it, 9 months period looks a bit longer, but it's not the case. You are basically obliged to make the payment in the 9-month period. So basically managing the cash flow is one important aspect of corporate tax, because you should be able to pay it within the 9-month period. So if you have basically 12 plus 9, 21 months from the start of the financial year to complete the whole process of the taxation.
Thank you, Jishan, for giving the sort of the timeline that people should be aware of. Obviously, there's a bit of time before filing and submitting your returns, but the work has to start right now in terms of getting yourself prepared for compliance. I'm going to take out a few questions that came in, and then we'll move to the concluding statements after that. So just going into our chat box here. Malik has a few questions that have come in. So Malik asks, do taxable income after transfer pricing sweep outs to parent company outside UAE? And does transfer pricing need to be registered with the FTA? Thomas, I think since you were discussing the transfer pricing, I'll let you answer this one. I think it's a very general sort of question.
Yeah, I'm not sure what a sweep out is. I'm not really familiar with that term, but when it comes to specific registrations, there is no requirement. There's no obligation to register your intercompany arrangements, for example, with the FTA. There's no obligation to get an advanced pricing agreement either. I think maybe what Malik might be referring to is remittance after, for example, allocating profits to a PE, what is left there and is then paid to the head office. That's not subject to any taxation. There is no withholding tax on any profit remittance, for example, from the UAE to abroad. I don't know if any of the other panelists maybe have something to add to that. Yeah.
Malik does have another question, so we'll move on quickly in the interest of time. Can multiple subsidiaries form a tax group if the parent is non-resident in the UAE? Jishan, so you're talking about the tax groups.
Yes. No, I think the tax group, it's very clearly mentioned that the tax group can be formed only between the resident company. So basically, if you have a parent company which is a non-resident, although they have a what you call it, a permanent establishment UAE, they cannot form a tax group. So it has to be very strictly the tax group should be formed between the resident entities in UAE.
Right. Go ahead, Thomas.
Yeah, to add to that, you cannot indeed only group it with UAE residents, but if you have a foreign parent, you will that holds multiple entities in the UAE, 95% plus, you would still not qualify. You need to have a UAE parent for the subsidiaries that you want to group.
Thank you for that. Malik had another question. He's asked, is there any limitation on back office expense allocation to an entity in the UAE? Jishan, you were discussing expenses. So is there any limitation on what expense allocation to an entity in the UAE?
I think back office expense allocation to an entity, it's more connected with the transfer pricing rule, and there is not something specific mentioned in terms of allocation of the expenses. So it's basically a company can decide, how they can allocate, especially when it is a tax group. There's no question you can allocate expenses between the offices the way you want it. And if you are basically a different entities, then you have to comply with the transfer pricing rules. I don't know whether Thomas has to add something to it, or Charles.
Yeah. Indeed, some countries provide or prescribe that head office costs can only be allocated on a certain basis, or they can't be done on a lump sum basis and whatnot. So indeed, as Jishan said, we don't have any domestic rules for this. Treaties may have these rules, but from experience, the ones that I looked at in regards to the UAE do not have such limitations. So indeed, the fallback would again be the transfer pricing regime or the transfer pricing principles in terms of the allocation of the profits to the PE.
And another question came in that asking, are accounts to be audited? So are the accounts to be audited? Charles, Thomas, Jishan, anything with respect to getting external audit on this?
If I can answer that question, yeah. So yes, there is a requirement, like mandatory requirement for preparing the audited financial statements, but I think those are for taxable person exceeding a revenue of 50 million in a calendar year. So for example, if your revenue exceeds 50 million in a calendar year, then it is mandatory for you to audit your financial statements. On the other side, the same requirement is mandated for qualifying free zone as well. So regardless of the threshold, if you are a qualifying free zone entity, you have to maintain an audited financial statement. Other than these two entities, everyone has to maintain a financial statement that is mandatory, but the auditing part is mandatory for these two categories only.
Thank you, Jishan. From here, I think we'll go to our concluding sort of statements. There's been a lot of information given here. I hope people found this useful. But as you know, companies start looking towards getting themselves prepared, what should businesses be doing right now? And are we supposed to be in a holding pattern? Do we wait till more legislation comes out? Charles, we'll start with you. If you can give your concluding statements on how business should prepare.
Yeah, you're not going to be waiting anymore. It's important to make sure that you're ready to start maintaining accounts as required by the new corporate tax law. If your tax year began on the 1st of June, then you had better be doing so right now. But if your tax year begins later, like on the example that Jishan gave on the 1st of January, you've got to make sure that your accounts as of that date are going to be in accordance with the requirements of the tax law. And if you're not doing things like following IFRS, or if you're doing like cash-based accounting and not accrual accounting, you've got to make sure that your systems are changed to address the requirements, so you can keep accurate track of your revenue, of your expenses, and everything else. It's a lot of companies were sort of shocked into compliance when the VAT law took effect, and I think this will be another little bit of a shock or a stress that'll give companies a chance to make sure that they really are keeping their accounts in the manner required. It's going to mean staff training and probably adding some people, making sure that the people you have on board, either in-house or that you're outsourcing to, understand the corporate tax law and have the ability to make sure the accounts are kept accurately, and that the tax returns are filed on time and also filed accurately. It's a new statute for the regulator as well, so I'm sure we'll see back and forth questions and audits from the regulator once we get down the road a couple of years. But the time to take action is absolutely now, yesterday, if you can.
Thanks, Charles. Thomas, you mentioned sort of you conducted some training. What should people be doing in terms of getting their processes ready, their people ready? Should they be getting them trained, and also what type of could they rely on the same processes they had with when it came to the VAT laws? Is that good enough for them?
It's a good question, and I agree with Charles. The 2018 shocked people into putting in place more reliable processes. Now, this is a slightly different approach, because VAT is transactional, whereas this is more an ex post thing that we look at. So I'll tell you what most of the work is that we're currently doing, which is analyzing the impact of how CIT applies currently on businesses, and then consider potential planning opportunities if at all possible. That's one thing. The other thing is to go into the accounts and see whether all of the accounts can identify things like exempt income, non-deductible expenses, these kind of things. And the training aspect is important, definitely. But I think, as you saw from the timeline as well that Jishan was projecting, there is still time before the first filing of the return. But I would say, especially when we look at the kind of having potential different structures to be implemented or small changes to processes, it takes a lot of time. So you see in front of you a couple of considerations around this, as well as on the next slide, a bit of a road. If we can go to the next slide, a bit of a roadmap how to get to the finish line, and the finish line would then be the filing of the CIT return. I don't like too much the word impact assessment, but for lack of a better word, we see how CIT applies on a business, and what are the attention points. Do some modeling as well. Modeling is sometimes very interesting, because we can see how a 9% statutory rate can actually boil down to a low effective tax rate. And I would say, especially when it comes to TP, but also international transactions, seeing what potential foreign tax credits are now available to U.A.E. businesses to compensate against the U.A.E. corporate income tax. It's been a very interesting ride. And I think the other thing, just to close on that and pass on the mic as well, is yes, there will be many changes. We expect that the framework is going to undergo annually substantial changes, definitely in the first couple of years. So it is a question of keeping your finger on the pulse constantly. Thank you.
Thank you, Thomas. Jishan, last sort of statements from you on how people should be getting themselves ready, technology, perhaps what type of things should they be looking into and thinking about. And
right.
Yeah.
Additional to what other speakers mentioned, I would like to also add to be ready with your financials like 1 year in advance, because you need to be your closing balance of the previous year, which it's basically going to be carried forward to the tax year. So you need to make sure that your closing balance, which is the pre-tax year closing balance, comply with the tax regulations, so that you can carry forward it easily, then start with an opening balance from the tax year going forward. And again, understanding the impact, that's very important, that they have repeated by Thomas. And again, hiring, allocating the resources, it's important. Certain costs are meant to be incurred by the company, a cost of complying with the regulations. So the companies has to basically try to allocate the resources, hire the resources, internal or external, make sure you are complying with the tax regulations. And again, just to add more, it's the financial obligations. There are deadlines to meet. You need to be managing your cash flow very well. There is no excuses going to be there after the deadline. You need to pay it on time. So you need to be ready with all the aspects of managing the company, managing the compliance of the company. So all of them ready for it.
Thank you, Jishan. And if I can add to what the gentlemen have said, as you can see, there, the corporate tax is very vast and complex, and there's different intricacy and details in the rules, and this is expected to grow as we sort of get further into the implementation of this law. What I would suggest to all our participants and all people who are looking to develop a successful business governance and compliance to this is don't go it alone. Do seek professional help in this subject, because this is not as straightforward, and it is a subject that is building and moving. And it helps to have someone you can partner with to ensure that they're keeping you abreast of the laws. They're ensuring that your compliance is correct, that when you're filing that your first tax return, you don't do it with any type of errors, because as we know, once you go into a situation where you have errors or something need to change, it becomes very, very difficult, and there's always the risk of fines and penalties, and we want to avoid that. So please do consult a professional on this subject as you get your company prepared for the corporate tax implementation. And with this, I'll just hand it to Murtaza Khan, who will be concluding this webinar. Let me introduce him really quickly. Murtaza Khan is a board member at AmCham Abu Dhabi and the chair of the Legal Affairs Committee. He's the managing partner at for Middle East and Africa at Fragaman. Murtaza is a regional managing partner, and Fragaman is the global leader in immigration services and solutions. And Murtaza has been based in the Middle East region for over 14 years and is responsible for its Fragaman's practices and network partners spanning across the region. In this capacity, he has extensive experience of working with large global and regional companies alongside representing the SME sector. He has a deep knowledge of regional business immigration, mobility, and deployment issues. Murtaza, thanks, and I'll hand it over to you.
Thank you very much, Zahir. I just wanted to say a word of thank you to all the attendees on behalf of the Legal Affairs Committee and the Banking and Finance Committee at the American Chamber in Abu Dhabi. We are very delighted to have hosted this valuable session today, which no doubt is an area of high interest for many, many companies. Of course, both of the committees, the Banking and Finance Committee and the Legal Affairs Committee, are open to members in the industry to join and engage with us because we have a lot of content coming out. I just speaking on the corporate tax event, we have one a more in-person event scheduled for September 20th, as you can see on the slide. And we, along with the Tech and Innovation Committee, have also another event on September 6th on technology and exploring the impact of AI and all those fancy things on productivity in the workplace. So please do engage with us. We have lots more content to come beyond the next 1 month as well. And we'd be delighted to host you. I wanted to just offer a note of thanks also to Zahir for hosting and moderating the session today. And of course, Charles Laubach, Jishan Mohammed, Thomas Vanhee, and the AmCham team, of course, led by Liz Beneski, Shorat Shodmanov, and Zeni Carpio. So thank you very much to everybody to put this together. It's been a very nice effort altogether. So with that, we'll just conclude the session today and look forward to seeing you over the next weeks.
Thanks, everybody. Have a good evening. Take care. We're signing off.